Welcome to Deluxe Finance. If you enjoy this type of content, then subscribe and hit the bell icon so you never miss out on any of our latest and greatest uploads. A recession is a period of slow growth where a country's economy begins to shrink. It's defined as at least 2 consecutive quarters of negative economic growth. It's not entirely clear whether there are official dates on which this slow growth must be observed. It's only required that an economy shrinks for at least 6 months. What can start as a small decline in the economy, often referred to as a recession, can turn into an economic depression. Both terms are defined by negative GDP growth. However, there are 2 important distinctions. The first and most important distinction between recession and depression is that the amount of decline in real GDP must be significant. If the real GDP declines by only 1 or 2%, then technically we would be in a recession. However, this kind of growth could hardly be described as depression. The distinction between a significant decline and a small decline also tells us something about how to prepare for the possibility of entering a recessionary period. The second distinction between recession and depression is that when an economy enters into a depression, the situation becomes much worse than in any previous economic downturn, so bad that some people can no longer find jobs. What sets depression apart from a recession is the extent of human suffering. In fact, during a depression, it's characterized by massive unemployment, sometimes as high as 25%, while during recessions, unemployment hovers around 6 to 8%. There are no quantitative measurements of a recession, and sometimes it can be difficult to tell if you're in one. A few warning signs that we're in a recession: the decline in the gross domestic product, or GDP. Unemployment increases significantly, up to 6 to 8%. A large number of people in poverty. The price of consumer goods and commodities such as food and energy increased significantly. A steep drop in stock prices. There's a significant decrease in the amount of money we spend on large purchases, such as cars and homes. During the pandemic, we've experienced a significant slowdown in the economy. Because of this, a recession has occurred. COVID-19 is considered a recession because it meets the criteria to be defined as one. The following scenarios contributed to the recession that occurred during the COVID-19 pandemic: a decline in consumer spending, decline in job layoffs and unemployment, decrease of GDP and average income per capita, a decrease in demand for most goods and commodities such as food, energy, clothing, etc. The stock market decline was caused by investors panic selling. This resulted in companies cutting costs, which contributed to the number of workers who were laid off. As a result, the economy experienced deflation or general price decline, making it difficult for companies to increase their market share. Businesses' increased demand for labor in response to COVID-19 affected both wages and employment opportunities. The effects of the recession are wide-ranging and can have long-term implications for the economy, including reduced overall economic activity, revenue shortfalls in local government budgets due to reduced tax revenue, hiring freezes, layoffs, or other cutbacks by employers to reduce operating costs, decreased consumer spending. People spend less money on luxury items or services, rises in the unemployment rate. There's no single definition of recession, though different descriptions of recession have common features involving economic output and labor market outcomes. A recession can be defined as a sustained period of weak or negative growth in real GDP output that's accompanied by a significant rise in the unemployment rate. Many other indicators of economic activity are also weak during a recession. For instance, levels of household spending and investment by businesses are usually low. In addition, the number of households and businesses that are unable to pay back loans are unusually high, as is the number of businesses that close down. Because these indicators are typically present when there's a significant increase in the unemployment rate is considered a reliable and timely summary indicator of a range of negative developments in an economy. The most common definition of recession used in the media is a technical recession, in which there have been 2 consecutive quarters of negative growth in real GDP. This definition often appears in textbooks and is widely used by journalists. On this definition, Australia had not recorded a recession for 29 years, since the recession of the early 1990s. This length of time since a technical recession is very unusual compared with Australia's economic history and the experience of most advanced economies, which typically record a recession around every 7 to 10 years on average. There are, however, a number of shortcomings of this definition of recession. GDP growth can be weak but not negative and still be associated with significant increases in the unemployment rate and hardship for households. Some components of GDP are volatile. Consequently, 2 consecutive quarters of negative growth in GDP can give a false signal about the underlying pace of economic growth. Measurement of the components of GDP is subject to revision as more data become available. Consequently, a negative quarterly growth figure can be revised away, or a positive one can become negative, also increasing the possibility of a false signal about the underlying pace of economic growth. Some commentators also consider alternative measures of economic output to assess periods where economic growth is easing or below trend. For example, some will focus on whether there have been 2 consecutive quarters of negative growth in GDP per person, or GDP per capita, which is a way of excluding the contribution of population growth to economic activity. Other commentators focus on consecutive quarters of negative growth in GDP, excluding some volatile parts of the economy, such as the farm sector, so as to avoid the effects of volatile movements on the pattern of economic growth. Economists have also proposed definitions of recessions that rely only on the unemployment rate. These rules typically signal a recession when the unemployment rate increases by more than a pre-specified amount. These unemployment-based rules have the advantage of being simple, timely, and not as susceptible to data revisions as GDP-based measures. However, the main limitation of unemployment-based rules is that the unemployment rate might not always capture a deterioration in other economic indicators, such as underemployment. As with recession, there's no single definition of a depression. However, a depression can be thought of as a much bigger version of a recession, both in terms of scale and duration. Consequently, in a depression, there are periods of falling output and high unemployment rates that persist for a number of years. The scale and duration of a depression means that there are often negative economic outcomes that are experienced in many countries around the world. So some definitions of depression say that it's a severe recession that occurs in one or more economies. And with that, we've reached the end of this video all about what a recession is. If you enjoyed this video and found it helpful, don't forget to leave a like and subscribe for more content just like it. Welcome to Deluxe Finance. If you enjoyed this type of content, then subscribe and hit the bell icon so you never miss out on any of our latest and greatest uploads. Recession. Just hearing that word can cause some people to clench their teeth, clutch their chest, and run to the bank. With crazy high inflation and rising interest rates, you've probably heard rumblings from talking heads on cable news that an economic recession is looming, or maybe you've heard we're currently in a rolling recession. So, how do you prepare to live through a recession? Well, it's a good idea to have your finances in order, always. But we're here to tell you how you can be prepared and not go off the deep end. So relax. You don't need to build a bunker, stuff a pile of cash under your mattress, or stock up on toilet paper. Bottom line, don't freak out. Here's how you can make sure you're prepared for a recession. With inflation up and our retirement accounts down, a recession feels more real now than ever. Having concerns right now is valid, but it's important not to give in to all the fear out there. You should instead focus that energy on making sure your finances are where they should be. At the end of the day, you need to have your own house in order and be ready to stick it out during a recession. That is going to matter a lot more than what's happening on Wall Street or at the White House. If you have a steady job that's secure right now, then keep working your debt snowball and paying extra on your debt just like you've been doing. Being debt-free will give you an overwhelming sense of freedom and peace. And when you aren't spending most of your paycheck on debt payments, things like higher grocery prices or a dip in the stock market won't hurt as much. Big companies, especially in the tech sector, have announced layoffs recently. So if you're out of work or have a potential job loss on the horizon, go ahead and pause your debt snowball. Listen, we get it. After all your hard work of paying off debt, it probably hurts a little bit to read that, but for right now, you've got to prepare for a storm. Make sure you cover your 4 walls first. That's food, utilities, shelter, and transportation. And stockpile some cash. Stop paying any extra payments toward your debt, but do continue to make the minimum payments if your 4 walls are covered, so your debt doesn't go into default. The most important thing is to take care of yourself and your family. And remember, no matter how scared you might feel if you lose your job, don't take on more debt. You're already in a rough patch, and debt is only going to make it worse and leave you in a pinch down the road. Debt is dumb, even when you've lost a job, even when you're scared, and even in a recession. Keep saving. Having an emergency fund is never a bad idea. Think of it this way. When a recession happens, you can rest easy knowing you have an emergency fund in place. Your emergency fund is the buffer you need between you and life all of the time, not just when there's talk of a recession. And right now is the time to make sure your dollars stretch even further. If you've been sorta budgeting all along, buckle down and give every single dollar a job to do by making a zero-based budget. When the stock market goes down, you might be tempted to sell your mutual funds at a loss and put the money into something safe to weather the storm. But hold on, take a breath, and don't let fear cause you to make a costly mistake. We say it time and time again, investing is a roller coaster ride, and the only people who get hurt on a roller coaster are the ones who jump off early. Instead, wait, ride it out. Stocks rise and fall all the time. And even if you've seen a loss in your investments, you'll only feel that loss if you take the money out. So leave your money alone. Keep your investments where they are and wait for the upswing to happen. Mutual funds are basically having a huge sale right now because the market's down. That means if you keep investing, you'll be investing in stocks through your mutual funds at crazy low prices. And when the market picks back up, and it will, you'll still be on that roller coaster, smiling as you see the big returns roll in from your on-sale investments. Above all, remember that investing for retirement is a marathon, not a sprint. And don't pull your money out just because some dude on the news told you to. Recessions are kind of like hurricanes. It's hard to predict when they'll hit and how much damage they'll cause. But instead of downed trees and smashed houses, the damage from a recession usually looks like this: lost jobs, a tanking stock market, and bankrupt businesses. Now, you might not personally feel the effects of a mild recession, though you'll definitely hear about them on the news 24/7. But a moderate or severe recession will absolutely get your attention. Just like hurricanes, the key to surviving a recession is being prepared and not freaking out. Recessions are a natural part of the economy, so it's a given that we'll have them from time to time. We've actually had 13 recessions since World War II, and the average length of each one was about 10 months. No matter what the economy does, this economic trouble is temporary. If you're hearing this, you've lived through at least 2 recessions, and you made it. With that being said, it's always good to be prepared for a recession. Remember, a recession means the economy has been in a slump for 6 months or more. But the money decisions you make every day impact you more than what's happening in the White House or on Wall Street. What have the last 6 months been like at your house? Think about it. Have your finances been in a recession of their own due to inflation or something else? If you've had a bad break, now is the time to really dig in and get serious. The world has generally enjoyed low inflation over the past 30 years or so. Only a few developing countries, notably Venezuela, Argentina, and Zimbabwe, have experienced hyperinflation, an economic situation so destructive that some economists have called it "when money dies." In most countries, inflation-targeting central banks have kept inflation under control, helped by globalization and floating foreign currency exchange rates that serve to tame external price pressures. But since the COVID-19 pandemic and the start of the Ukraine war, high and accelerating inflation has reappeared in developed economies for the first time since the 1970s. Could Western countries such as the U.S. also experience hyperinflation? Hyperinflation is a devastating and often permanent collapse of the value of money. So much so that a major book about Germany's famous bout of hyperinflation in 1922-23 was entitled "When Money Dies." Hyperinflation is characterized by extremely rapid price increases in all goods and services. In the worst-known cases of hyperinflation, prices doubled in days or even hours. When prices rise this fast, people rush to spend their money as soon as they get it. As a result, the velocity at which money circulates in the economy rises exponentially, feeding the price rises. Hyperinflation is thus also known as hypervelocity. It's important to distinguish between high inflation, say 10% or slightly more per year, and hyperinflation. In a seminal 1956 study, National Bureau of Economic Research economist Philip Kagan defined hyperinflation as consumer price index increases exceeding 50% per month. For comparison, the U.S. Federal Reserve CPI inflation target is 2% per year. Countries can experience high inflation for years without it developing into hyperinflation. For example, Argentina's inflation rate has exceeded 25% per year since 2017 and twice topped 50%. But it hasn't yet shown the exponentially rising prices characteristic of hyperinflation. Argentina last experienced hyperinflation in 1989-1990, when the International Monetary Fund estimates prices soared by 2,600% per year. Monetary economist Cullen Roche defines hyperinflation as a disorderly economic progression that leads to complete psychological rejection of the sovereign currency. He argues that hyperinflation is a fundamental breakdown of trust in government and its institutions. His view is echoed by the Bank of International Settlements, which noted in a June 2022 paper that hyperinflations typically follow periods of major political upheavals and a generalized loss of confidence in institutions. Fortunately, hyperinflation is a rare phenomenon. In 2013, Cato Institute economists Steve Hanke and Nicholas Kruss published a list of 56 known instances of hyperinflation, the first of which was in France in 1796. Hanke later added Venezuela's recent hyperinflation to the list, bringing the total of known instances to 57. The World Bank has warned that because of the war with Russia, Ukraine may also be on the brink of hyperinflation. A key reason hyperinflation is so rare is that before it can happen, a country must experience a series of financial crises without effectively managing them. There are generally 4 stages in the run-up to hyperinflation. Stage 1. The country builds up high levels of debt, either private, public, or both. Some or most of this debt is denominated in foreign currency, perhaps because of a long-term trade deficit or from financing a war. Stage 2. A crisis, political, economic, or financial, severely damages the country's productive capacity. This causes the government tax income to fall, which in turn causes the fiscal deficit to widen sharply. As a result, the country's sovereign currency exchange rate starts to fall relative to other countries, and inflation starts to rise. Stage 3. The economic crisis and rising fiscal deficit damage confidence in the government, which loses its ability to borrow from financial markets or from its own citizens. So it chooses to print money via the central bank to finance its obligations. Stage 4. As the money printing becomes widely recognized, the last vestiges of confidence in the government is destroyed. The currency exchange rate collapses and hyperinflation takes off. Most economists agree that hyperinflation happens when people lose confidence in their government institutions, particularly the currency, due to a political, economic, or financial crisis. It is worth remembering that hyperinflation is quite different from high inflation. Business strategies exist for dealing with high inflation, but with hyperinflation, prices rise exponentially. They're out of control. Further, hyperinflation, with its combination of economic crisis and runaway inflation, may sound similar to stagflation, but the two are entirely different economic phenomena. Stagflation is the combination of inflation and low or no economic growth, usually accompanied by high unemployment. While hyperinflation destroys a country's currency and sometimes its government, stagflation merely makes people's lives miserable as the inflation erodes the value of their money and the lack of economic growth limits their ability to make more. Recessions can come during periods of stagflation, but they don't always. There are several things people prepare for in life, and hyperinflation is one of them. Even if there's a low chance of hyperinflation happening, high inflation still hurts economies and finances, so you must take proactive steps before the situation arises. Waiting for the excessive inflation increase only reduces your purchasing power. It might become hard to afford the things you need and also difficult to find them. So preparing for hyperinflation helps you protect your financial stability. The following are ways to prepare for hyperinflation. Number 1. Look for stores of value. An example is a non-perishable item like a generator. All non-perishables are stores of value, so it's better to buy a generator and store value in it than in currency. Number 2. Don't try swapping your local currency because of huge taxes. Also, the government may impose capital controls and may even illegalize forex trading. All these are to prop up the falling currency. Number 3. Spend money on the necessities, keeping in mind that for every day the cash is unspent, it loses value. So it's better to make significant purchases before hyperinflation hits. Number 4. Try to diversify your income and don't depend on a single source. Like everyday inflation, follow the 60-40 rule for stocks and bonds. Then look for a bank with a fixed interest rate and keep your money there. Finally, know that hyperinflation is a systemic problem, so there's little you can do to change it. The best course of action is to adapt to avoid its effects as much as possible. What should you buy before inflation hits? Should you go for the best prepper food first or make other strategic and informed choices? Following, we cover what to buy before hyperinflation hits. Real estate. Suppose you have plans to buy a home and you've saved for it. Buy it before hyperinflation. If you delay, prices will get inflated and the median market price will get higher than it is now. The property price increase is largely due to the increased price of raw materials. If you already have a down payment on a house, your mortgage payments will likely remain the same. But if you can pay it off before hyperinflation, it is advisable to do so. Precious metals. The value of precious metals, especially gold and silver, increases during hyperinflation. This is mainly because the value of these metals doesn't change like cash. As a result, they always appreciate while currencies can depreciate. Commodities. This largely covers food items and other necessities. Knowing how to survive hyperinflation means understanding the type of food to park and how long it will last you and your family. There are certain types of supplies you must have. Dry foods. Dry foods always make it into the survival food buckets. The United States has been experiencing food shortages since the early days of COVID-19. This affected dried items like pasta, beans, rice, and spices, and could eventually lead to a worldwide food shortage. The war in Ukraine means that this situation may persist for a while. The increased inflation is also a major factor, so stock up on dry food items because grocery stores don't hold very much. While most of them, like pasta, do have expiration dates, they have a long shelf life, unlike canned foods and other perishables. Other food items to purchase when preparing for hyperinflation are wheat, corn, potatoes, and dairy. Another essential commodity to buy before hyperinflation hits is canned foods, including vegetables, fruits, and meats. These foods are easy to store and use in different ways. For example, you can dry or buy dried meat. Dried meat can last up to a year if refrigerated. However, vegetables and fruits won't last that long. Also, ensure the canned products have a long expiration date. If you buy products that would expire in a month or two, it defeats the purpose of stocking up before hyperinflation. Keep in mind that canned foods are more expensive than what you'll buy from the farmer's market. But if that's what you'll eat, ensure you stock up. It's an excellent idea to buy seeds and grow your food if you're into gardening. However, there is a limit on what you can grow. For instance, you can grow vegetables and herbs, but you can't plant rice or beans in your backyard garden, so grow what you can and buy what you can't. Include baking supplies in the list of what to buy before hyperinflation hits. Purchase baking soda, flour, yeast, and salt. These items can last a few months before going bad if you store them in a cold, dry place. Craved and daily items are not food but commodities people can't live without and use daily. Examples are toothbrushes, detergents, toothpaste, alcohol, cigarettes, etc. Even if you don't smoke, you can buy and sell cigarettes to those who do when scarcity peaks. Don't forget to stock up on coffee if you're a drinker. If you have children, buy snacks, diapers, and a first aid kit. The latter is important because you must look after your health even in times of inflated prices and scarcity. So purchase over-the-counter medications, vitamin supplements, and immune boosters. Hyperinflation causes an increase in electricity bills. The best way to get ahead is by investing in solar power, especially if you live in a place with lots of sunlight. Get solar-powered tools and solar-powered appliances. This will keep you less reliant on electricity providers and help you save money during hyperinflation. Hyperinflation often affects people who keep cash and those who earn fixed salaries the most. As their money depletes, they might resort to other ways to get funds. This is why there's unrest during inflation or hyperinflation. Historically, there's a relationship between crime and high inflation. Therefore, you need to invest in security tools to protect yourself and your loved ones. If you don't have one, buy a home security system, tasers, and pepper sprays. Also, your house can be a target if word gets around that you have stocked up food, so take security seriously. Aside from all we've discussed, you can purchase certain assets that resist inflation and keep you financially buoyant. So consider investing in Treasury inflation-protected securities, or TIPS, real estate investment trusts, or REITs, the S&P 50, and real estate income. Furthermore, car prices go up during hyperinflation, so you might consider making a down payment now if you want to get one. If you already have one, buy parts and store them. It's wise to buy engine oil and extra tires. Also, ensure you have enough storage space for the items you buy. If you don't, make a shed for large items. Alternatively, clean out your cabinets and rid them of things you no longer need. Then use the space to store your food and other items. Finally, don't go into debt in trying to prepare for hyperinflation. It won't help to sink into a financial hole while trying to avoid one in the first place. Instead, create a list using the economic principle of the scale of preference and work from the most important to the least. Another way to survive inflation and protect yourself from its effects is to build a support network with like-minded people. Sharing resources, knowledge, and skills can help you navigate difficult times more effectively. Additionally, learning new skills such as gardening, food preservation, and basic repair work can make you more self-reliant and better prepared for economic uncertainty. You may never live through hyperinflation, but being prepared doesn't hurt. Again, while you cannot control the economic situation of your country, you can limit the harm you suffer as a result. So follow our list of what to buy before inflation hits, but also make sure to prepare for everyday emergencies. Have a bug-out bag list and go through it. Put together your 72-hour food kit and get a start on prepping for any emergencies that might come up. Real estate is almost always an excellent investment and should be at the top of your list. Under normal circumstances, commercial real estate is the most lucrative investment opportunity. However, the last few years have been anything but normal circumstances. Work from home and hybrid work schedules might become the new standard, so commercial real estate is currently in limbo. On the other hand, residential real estate is a white-hot market right now and could be where you should focus your attention. Since 1991, the average annual growth in home value has been about 4%. That's more than enough to cover the average annual rate of inflation. Another benefit is that rent prices have been skyrocketing. You can buy a new home for yourself, rent your current one, and charge a considerable amount of money each month. Naturally, some risks are inherent when owning multiple properties. The cost of financing the purchases and routine maintenance may mean that you likely won't see a profit for quite some time. Also, there's always the risk of another housing market crisis like the one in 2007 and 2008. The good news is that you don't have to take on these risks alone. Real estate investment trusts, or REITs, are publicly owned companies that own real estate and mortgages. By investing in one of them, you'll be able to experience the potential windfalls of real estate without buying any property. The money pooled together can lead to larger purchases with much lower personal risks. The U.S. Treasury sells savings bonds that are designed to earn interest based on a fixed rate and one that's adjusted for inflation. The interest rate is set once every 6 months and will be altered based on the current rate of inflation. For example, the current interest rate for an I bond is 9.62% and is set through October 2022. The rate will either be increased or decreased based on the current state of the economy in the fall. The good thing about I bonds is that they are both short-term and long-term investment opportunities. An I bond will only earn interest for 30 years, but you can cash it out after a year if you'd like. However, if you cash it out before 5 years, then you'll be assessed a penalty of 3 months of interest. But after 5 years of purchasing your I bond, you can cash it out with no such penalty attached. Stocks are one of the most common investments in the U.S. While you might become a billionaire, you might also lose a lot of money by making bad investments. Buying stocks is the riskiest option on this list, but the potential gains make it worth talking with a brokerage firm or investment trading company. The key to investing during times of high inflation is to look for options where consumers can offset the higher costs. For example, utility stocks commonly pay dividends to their shareholders that can provide you with passive income. The profits are less susceptible to market instability. Rising costs typically mean rising prices for consumers, so profits are almost always in the black. Another solid investment strategy is to get involved and follow a specific index, such as the S&P 500 or NASDAQ 100. The money you use to purchase your index fund is used to invest in all the companies involved with that specific index. Your fund will be highly diversified, which can significantly mitigate the risks during inflation. Plus, you'll be able to get involved at a much lower cost than if you wanted to buy individual stocks in each company. Silver and gold are precious metals that have been used as currency as a means of exchange for centuries. The US dollar was backed by gold until August 15, 1971. Then President Nixon officially abandoned the gold standard. In the decades since, silver and gold have remained strong investments for many people. The best time to buy silver or gold is when the currency is losing value during times of inflation. When the dollar weakens, commodities become more expensive. More on that later. Historically, silver has performed better than gold during inflation. However, gold is the more expensive option and roughly 70 times more expensive than silver. It might be a good idea to invest in both to help hedge your investment. You'll have two options for investing in silver and/or gold: to physically buy some or invest in ETFs that track them. Physically purchasing silver and gold can be risky unless you know what you're doing. You'll need to be careful and make sure that what you're buying is worth the price that you're paying. On the other hand, investing in an ETF can be a much safer bet, and you won't have to worry about storage. As mentioned earlier, the price of commodities typically increases dramatically during periods of higher inflation. This creates a unique investment opportunity that can be extremely lucrative when handled correctly. However, it's important to note that the price of commodities is determined by supply and demand. It's just as possible that you could lose money by investing in commodities. The key to investing in commodities is timing. Raw materials such as oil, natural gas, grain, beef, coffee, cotton, soybeans, and copper have all experienced an increase in value over the past few years. In particular, the price of oil skyrocketed after the Russian invasion began in late February 2022. A lot of people made a lot of money by investing in oil as a commodity just before prices jumped. The same was true for the price of wood. The supply chain for wood and other building materials was severely disrupted by the pandemic. However, the demand stayed roughly the same. As a result, the price of wood skyrocketed, and shrewd investors were able to make an enormous profit. Unlike silver and gold, most other commodities have an expiration date. It would be ludicrous to purchase a ton of avocados and attempt to sell them for profit. Look into ETFs that track specific commodity indexes. You can safely experience the potential windfalls of a price increase without the risk of being stuck with expired commodities. Cryptocurrency is a digital currency that records transactions onto a digital ledger known as a blockchain. It's quite a bit complicated and still a very new investment opportunity compared to the other options on the list. There's a lot that remains to be seen about how cryptocurrency holds up against inflation. It's a very high-risk investment option, but it also has the potential to be a very high reward. The primary reason that cryptocurrency can be such a lucrative investment is because of a limited supply. Cryptocurrency mining is very costly and doesn't come with immediate rewards. As a result, the market isn't flooded with a ton of new cryptocurrency, which means the existing cryptocurrency holds its value very well. Another benefit is that cryptocurrency is decentralized and isn't controlled by any government or financial institution. The lack of oversight makes it quite a gamble to invest in, as recent markets have shown, but allows for a much higher reward. Investing in the other options on this list is probably a smart idea. However, you could see a huge return on your investment by purchasing a few cryptocurrencies. If you enjoyed this video and found it helpful, don't forget to leave a like and subscribe for more content just like it.